Hello, traders, and welcome to today's episode. And this is part of the Forex Advanced, a very important episode that you might not want to miss it out in terms of because it is very important in terms of helping you to improve your success in the Forex trading. So, and today's topic is how to create a Forex trading plan. So, failure to plan is plan to fail. And a trading plan is a trader's constitution. So if you bend the rules, of course, you make losses. So for you to understand a trading plan, you need to know that creating an effective Forex trading plan is crucial for achieving consistency, managing risk, and improving decision making in the fast-paced Forex market. So like I always say, Forex trading is 60% psychology. And the trading plan is what is going to help you improve your psychology. You might be good in charts, analyzing the charts, fundamentals, technical, sentimental, but if you miss it in the psychological bit of it, then you might not be successful. You might not realize the success that you want to achieve. So a well-structured plan acts as a roadmap, guiding your trading decisions and helping you stay disciplined. So in this video, I'm going to take you through a step-by-step guide to crafting an effective Forex trading plan. So the first step in creating a Forex trading plan, an effective Forex trading plan, is to define your trading goals and objectives. So you need to set what we call heuristic goals. So you determine what you want to achieve in Forex trading and be specific. So your goals must include a certain, maybe probably annual return percent, maybe a weekly or monthly income goal, or maybe probably simply gaining consistent profitability. So you have to set, or the goals that you set needs to be very, very realistic. For instance, if you are very new in Forex trading, you cannot have a goal like maybe probably make, let's say maybe probably want to make, let's say maybe 100% returns in your first 6 months. So it might not be possible because that is not a realistic goal because you are very fresh into Forex trading. You have not gained the experience that is needed for you to attain such kind of success, right? So when you're setting these goals again, it's good to ensure that these goals are also achievable, right? So I like using the acronym SMART. So SMART basically is standing for specific, um, M standing for measurable, A standing for attainable, uh, then R standing for realistic, and T standing for time bound, right? So once you're doing those goals, use the SMART acronym. Then you can be able to have like 5 years goals or 1 year goal, and then you break that big goal into small goals that are measurable, trackable, maybe monthly, weekly, or daily, right? Then you need to align your goals with your risk tolerance. So goals should reflect your risk tolerance and account size. For example, aiming for a 10% monthly return may require high risk exposure than a goal of 2% per month. So you have to know your risk tolerance and then you set your goals according to the risk tolerance. But again, the key thing that is guiding you is to set realistic goals. Don't set very high goals that you might not be able to achieve. Remember, if you set goals that you're not able to achieve, what might happen is that you might feel discouraged along the way. But if you set small goals, keep achieving those milestones, then what it does is that it boosts you or it increases your motivation or your morale, and then you go scaling higher as you proceed. So number two, you need to choose a trading style that fits your lifestyle. This is very important. So we have different trading styles: scalping, day trading, swing trading, position trading. So when you're settling on a particular trading style, make sure that it fits your lifestyle. Choose a style that aligns with your personality and time availability. If you want to be a scalper, scalping basically involves making quick trades for small profits and requires close market monitoring. So this means that you need to have really time, a good amount of time to spare in terms of looking at the charts. Day trading, this is where trades are opened and closed within the same day. Also, this means it might require some bit of time for you to to keep checking on the charts. Then we have swing trading. And these are trades in swing trading. Trades are held for several days or weeks, aiming to capture large price swings. All right. So you can see now as we move to the swing trading, there is a bit of flexibility. You don't need to keep looking at the charts all through. Then position trading. This is where long-term trades takes place that may last months, focused on capturing major trends. So this is also what we call investing, because you take a position and then you'll close or you'll hold that position for some months, and then you can close it maybe once your target is reached. Then time commitment is very important. So your style should fit with the time you can dedicate to trading, right? So the reason why we are looking at the different styles, scalping, day trading, swing trading, position trading, is so that you can be able not to look at time as well, because your style that you're going to choose should fit with the time you can dedicate to trading. Scalping, for instance, demands intense focus and time, whereas swing trading allows for a more flexible schedule. All right. Then number three, define your risk management rules. All these things should be in your trading plan. Determine the risk per trade. Decide the maximum percentage of your trading capital you are willing to risk per trade. The rule of thumb is that do not risk more than 1 to 2% of your account. So this helps you prevent large losses from a single trade. Again, I'll emphasize here, if you're talking about risking 1 to 2% of your account per trade, that means that you are taking one trade at a time. So if you take a trade, so if it hits your TP, you look for another trade, or if it hits your stop loss, you look for another trade. If you are going to take multiple trades, ensure that the cumulative risk of all your trades should not exceed 2% of your account capital. Then you need to set risk to reward ratio. This is very powerful. Establish a minimum risk to reward ratio, like maybe probably 1 is to 2, 1 is to 3, 1 is to 4, depending on the strategy that you use. So this ratio means that for every dollar risked, you aim to make $2 or $3, which helps maintain profitability over time. You may have, or you may want to look at a scenario whereby you have maybe a sample of 10 trades. So out of these 10 trades, six are winning trades, six are losing trades, and four are winning trades. So, but if you from a bear point of it, if you look at that kind of a scenario, 60% you are losing, 40% you are winning. So overall, it means that you are losing generally. But if you apply a risk to reward ratio of 1 is to 2 or 1 is to 3, even if your win rate is 40%, and your losing rate is 60%, at the end of the day, you'll be able to make some good money, right? You'll have made some profit at the end of the day. Then you need to set daily and weekly loss limits. I know most of the traders overlook onto this. Most of the traders do set only the profit targets and they forget about setting the loss limits. So having a daily or weekly maximum loss limits will prevent you from overtrading and can stop you from making impulsive trades after a losing streak. So anytime your daily or weekly loss limit is hit, what it means is that you stop trading for that particular time, and then you wait maybe probably until the next day or maybe until next week, or you can even decide to go back to your demonstration account, perfect your strategy, and then now come back to live trading. So the other key important thing is determining your position size. So you need to develop a rule for calculating position sizes based on the risk you are willing to take per trade and the trade's stop loss distance. I'll be able to demonstrate that when we'll be talking about when I'll be showing you how to create this trading plan. All right. So, number 4, you need to choose your trading strategy. Remember what we discussed there above up, we talked about the trading style, scalping, day trading, swing trading, and position trading. Those are trading styles. So number 4, you need to look at you need to choose your trading strategy. So select or develop a strategy. So your strategy should outline the specific conditions for entering and exiting trades. So some of the few popular options that we can have here is like the trend following. So look for entry opportunities in the direction of the prevailing market trend. So if it's a downtrend, look for sales opportunity. If it's in an uptrend, look for buying opportunity. The other common or popular option is trading the breakout strategies. So you enter the trade when the price breaks through a key support or resistant levels. Then we have the reversal strategy, which identifies potential trend reversals using maybe indicators like the RSI, which shows overbought and oversold signals, using the Fibonacci retracement levels as well, which will show you the likely points that the price is can tend to retrace to. Then you have to define your entry and exit criteria depending on your trading strategy. So specify the conditions under which you'll open and close trades. For instance, enter trades when the price breaks above a resistant level, or exit when the RSI signals overbought conditions. Also, if you're using maybe the engulfing candlesticks pattern, you might want to buy when the price retests a bullish engulfing and exit when the price reaches maybe a resistant level or it reaches a bearish engulfing. So the other important thing is to avoid strategy overload. So stick to one or two strategies to keep your plan focused. A straightforward strategy with clear rules can help prevent confusion and indecisions. I'll suggest I'll suggest only one strategy. So focus on one strategy and become a master of that strategy. And now what you'll be doing is that you'll be trying to add more confluences so as to increase the probability of that strategy working out. So like I said, you can select or develop a strategy. So selecting a strategy means that you are going to look at different strategies that already exist that other traders have invented, maybe support and resistance, candlesticks patterns, chart patterns, Fibonacci retracement and extensions, the ICT in terms of order blocks, breaker blocks, FVG, liquidity levels, or maybe even supply and demand, or any other strategy that exists. So once you pick that strategy, then try to increase the confluence so that now you can enhance the probability of winning trades. Or you can decide to develop your own strategy. So this is whereby you become innovative. You need to spend a lot of time in the charts. You look at the charts and then you'll maybe probably see or come to notice that there is a particular way that a market behaves in a certain way during maybe a certain time. And out of that, you're able to come up with your own strategy. Then, number 5, you need to establish your trading routine and market analysis process. So, in terms of market analysis method, we have 3 types of analysis. We have the technical analysis, we have fundamental analysis, and sentimental analysis. So decide on the type of analysis that you'll use, but I will recommend a combination of the 3 strategies so as to try and increase your probabilities or to increase your confluence. So the first analysis method we use, the commonly used is the technical analysis, which relies on price charts, indicators, and patterns to identify trading opportunities. We have fundamental analysis, which considers economic indicators, central bank decisions, and global events. Then we have sentimental analysis, which gauges the market moods to understand potential trades and reversals. For instance, the COT report here, that is the Commitment of Traders report. It's a very nice way of looking, a very nice way of sentimental analysis. Then you need to define your trading routine. Create a routine that includes pre-market analysis, trade setups identification, and post-trade reviews. A typical routine might involve reviewing economic news in the morning. So when you wake up, maybe you want, first of all, you go to the Forex factory, you look at the economic news that we are anticipating that day. Then you go to the technical analysis, whereby you analyze the charts for setups. And once you take those setups, now you can journal after the trade sessions. So after the end of the trading period, journal those trades, and we shall be able to look at I did a video actually about journaling, so you can go and revisit that video, watch that video and see how we do the journaling and also the importance of journaling. So the other important thing that you need to consider is to outline your risk and money management plan. Again, this is very important because the goal of risk management is for you as a trader to be able to minimize your risk and also to preserve your capital, right? To minimize your risk or maybe to minimize your losses and to preserve your capital. So how do we do this? Use stop loss orders. For every trade, set a stop loss order to protect against significant losses. Use stop loss levels in every trade that you take. Ensure that you have a stop loss. So the stop loss level should be based on technical factors such as recent support or resistance rather than arbitrary dollar amount. So because I have seen traders just maybe say that they want to risk $20. So they take a trade and put a stop loss. They pick a lot size and put a stop loss where the $20 mark is. And you might find technically that's not a favorable place to put your stop loss. So what will happen is that your stop loss will be hit and you lose that trade. So instead of looking at the arbitrary dollar amounts, look at or be guided by the technical factors, the key levels that the technical analysis gives you, and factor and consider putting your stop loss based on those levels. For instance, support and resistance, all right? If you're trading order blocks, maybe a bullish order block, put your stop loss slightly below the bullish order block, all right? So then the take profit levels, you need to define your take profits in line with risk to reward ratio. So having predetermined exit points for profitable trades can help lock in gains and prevent emotional decision making. So for me, I don't take any trades if they don't give me, if they don't have a potential of giving me a risk to reward ratio of 1:2. So anything less than that, I don't take the trade. I don't take the setup. So I want a setup that is going to give me a risk to reward ratio of at least 1:2. All right, or maybe 1:3 and above. So the minimum I can take is 1:2. So then avoid what we call over leveraging. So forex trading often provides high leverage, but overusing the leverage can increase the risk because the higher the leverage, the higher the risk. So limit the leverage based on your account size. Again, also based on your risk appetite, and keep leverage low until you're consistently profitable. Then you need to define trade management and adjustment rules. And here we shall talk about plan for trade adjustment and avoiding emotional adjustment. So how do you plan for trade adjustment? You need to decide ahead of time if and how you will adjust trade in real time. This could include moving the stop loss to break even when the trade reaches a certain profit level, or scaling out of a position gradually. That is what we say taking partial profits. So like for me, if I'm targeting a risk to reward ratio of 1:2, what happens is that when the trade gives me goes half of my target, what I'll do is that I will put my stop loss at break even and I will take partial profit. Then you need to avoid emotional adjustment. How do we avoid this? So your trading plan should specify that adjustment to open position or open trades should be based on predefined criteria rather than emotional impulses. Like I've given you an example, my trade adjustment criteria is based on predefined, it's a predefined criteria. So I have it that if the price gives me a half of my target, what I'll do is that I'll take partial profit and put my stop loss at break even. So as you can see, that is a very predefined criteria. And this is what is going to avoid you, to help you to avoid emotional adjustments. Then you need to create a record keeping and review system. This is where now the journaling comes into consideration. So maintain a trading journal, and this means recording each and every trade, including your entry and exit points, position size, the reason for the trade, the outcome, and your thoughts or emotions. So a journal is invaluable for reviewing and learning from past trades. Like I said, I have a video in my YouTube channel talking about how to create an effective trading journal. So you can rewatch that video and you'll be able to understand how to keep these records or how to maintain a trading journal. Then analyze your performance regularly. So the purpose of the trading journal is to help you now analyze the performance, because whatever is not journaled, you cannot be able to review it. You cannot be able to review those trades, the performance of those trades. All right. So review your journal weekly or monthly to identify patterns in successful and unsuccessful trades. So you want to consider both successful and unsuccessful trades. So for the unsuccessful trades, they'll help you identify your mistakes so that now you can be able to avoid those mistakes in the future. For the successful trades, they are going to show you where your strength is, and maybe probably you can even have, or you can get maybe some ideas about maybe what you can do extra to make or to increase the probability of your winning trades, or to increase the probability of your success. So then now, once you analyze your performance, you need to set improvement goals based on your on reviews. So let's say maybe this week you made 2% and you have realized maybe some of the mistakes that you made in terms of trading that made you not even to attain the 5%. So as you go to next week or maybe next month, you want to put those mistakes into consideration. So you try to rectify or you try to avoid those mistakes. And what it will do now, that you'll see that maybe next week you'll move from maybe 2% to maybe 3%. So there is an improvement. So it will help you to set, trading journal will help you to set improvement goals based on what you find in terms of analyzing your performance or reviewing your performance. So in a layman's language, what I'm trying to say is that use your review sessions to set small, achievable goals for improvement, like reducing the average losses or maybe improving discipline on entry criteria. Then you need to have a continuation plan. So a continuation plan is very important. And how do you have a continuation plan? This is whereby you invest in education. You understand that Forex is a dynamic market, so staying up to date on new strategies, market developments, and trading psychology is important. So you can consider maybe taking advanced courses or maybe attending webinars or interacting with the traders in different communities, basically to try and enhance your knowledge or enhance your education. Then you need to be adaptable to changing market conditions. So the market keeps changing. So market evolves with time, and so should your trading plan. So that means that that your trading plan is not static. So you can keep adjusting your trading plan basically to adapt with the changing market condition. So make periodic adjustments to your strategies based on performance reviews and market shift. Then engage with other traders. And this is very, very important. Joining a trading community, all forums can offer insights into market trends and new strategies, although it's important to filter information and stick to your plan. So as much as it is good for you to join these trading communities or maybe other trading forums, it is also quite essential for you to be able to filter the information that you're taking in and also to stick to your plan. Then you need to stay committed to discipline and psychological management. Success comes with discipline. All discipline is very key for you to attain success. So stick to your plan. Once you have a plan, follow it meticulously. Avoid impulsive trades or change in position size, which can undermine your strategy. Then control your emotion. Trading can be very emotional. It is very emotional, especially during high volatility. So have techniques in place such as taking a break, or maybe setting predefined limits to manage emotions like fear, greed, or frustrations. Then know when to take a break, or knowing when to take a break is very important. So if you are experiencing, for instance, consecutive losses or feel emotionally overwhelmed, step back from trading to prevent further loss and maintain a clear mindset. So once you have a clear mindset, then now you can resume trading. So this is just a summary of a sample trading plan. What you can call it a sample trading plan strategy. So of course, number one, you need to set your objectives. So outline your short-term and long-term goals. In terms of trading style, specify your chosen style. For instance, day trading, swing trading, position trading, scalping. Risk management, you need to set risk per trade, daily, weekly loss limits, and also risk to reward ratios. In terms of market analysis, detail your analysis methods and any indicators used. We have three types of analysis: technical, fundamental, and sentimental. In terms of entry and exit rules, so your trading strategy should define your criteria for entering and exiting trades. In terms of position sizing and leverage, detail how you'll calculate your position sizes and manage leverage. Then routine and review, outline your daily routine, journaling process, and review sessions. Psychological management, very important. Specify how you'll manage emotions and staying disciplined. So what we are saying is that a forex trading plan, it's a very dynamic document, or it's a very important document, and you need to update and refine it as you gain experience and adapt market changes. So if you're going to follow your trading plan consistently, you realized improved decision making, enhanced discipline, and increased chances of long-term success in forex trading. So what I'm going to do next is that I'll show you probably how you can be able to craft one, maybe how you can be able to craft a trading plan. And this is why I want you to follow me keenly. So you will come and maybe probably in a spreadsheet. I'll show you how to do that in a spreadsheet, Excel spreadsheet. So what you want to have, the components of your trading plan, like you have said, number one, you want to have your objectives, all right? You want to have your objectives very well calibrated. So maybe you can have sheet one, and this sheet one, you can name it objectives, right? So what are your objectives? So determine your long-term and short-term objectives, all right? So maybe short-term objectives. So if you have short-term objectives, some of the short-term objectives that you can have maybe is like, for instance, if you are very new into trading, maybe you might have a short-term objective like maybe to complete a forex trading course, right? A forex trading course in 3 months' time, right? In 3 months' time, right? So you can have such kind of a short-term objective, and maybe probably in terms of long-term objective. Long-term objective maybe is to say that probably you can have a long-term objective like maybe growing or compounding your account, maybe to up to maybe probably you can maybe say even $1 million. All right. So this is long term. Maybe it can be 10 years, it can be 5 years, depending on the capital that you have to start. Okay. So you can list any other short term or long term objectives that you have. All right. So then you can have sheet two, and sheet two you can maybe use it in terms of your trading style, all right? Your trading style. So here you can outline your trading style. That is, for instance, maybe swing trading, day trading. So let's say maybe, for instance, you choose swing trading. So maybe you can highlight the reasons for your risk trading here. Maybe depending it's because of your time, or maybe it depends on your risk appetite, or any factors that makes you feel that swing trading is your trading style, right? Then sheet three, you can talk about risk management, right? Risk management. And under risk management, this is where you set risk per trade. So maybe probably you can say that maybe risk, maybe probably 1% of your capital per trade. Then you can set maybe probably your risk to reward ratio, right? You can have your risk to reward ratio set. Maybe probably you can say risk to reward risk to reward ratio, uh, risk to reward ratio of maybe probably 1:2. Right, so that means that you're targeting, if you're risking 1%, therefore you are targeting 2%. All right. So then you can also have your daily or weekly limits. So probably you can say your daily loss limit. Maybe you can talk about maybe you want to risk maybe 1% of your account per day. So if your daily loss limit is hit, then you are out of the market until the next day. Then you can even have your weekly, or maybe probably your weekly loss limit. So maybe you can say if you maybe probably attain a loss limit of maybe 3% per week, you can stop trading and wait until the next week, or maybe you can go into your demonstration account to perfect your strategy. So anything pertaining risk management, you have it written there, well written down. Remember, whatever is not written down is vapor, so it's good to write it down. So then you can, number four, you can talk about market analysis. So this is how you do your market analysis. So you can talk about maybe before entering a trade, maybe you can do a top-down analysis. All right, top-down analysis. Probably you also consider looking at consider checking the fundamentals or economic events, all right, economic events, so that you know which pairs are going to be affected during that trading day or maybe that trading week. And also in terms of market analysis, maybe if you use indicators, you can talk into details about the types of indicators, right? Types of indicators you use, and what the indicator should show you, so that you can be able to know that maybe it's a buy entry or it's a sell entry, right? So also you can consider, now here you can also consider maybe mentioning the strategy that you use, all right? And anything that lies under the market analysis is very essential here. So then you can go to the next one, where maybe you can talk about the exit, right? So this is about the exit and entry rules. Now here, what you'll do is you will define your strategy into details. So this is what you want to see, all right? Maybe probably you trade the engulfing. Your strategy is maybe you trade the engulfing candlesticks, right? Engulfing candlesticks, or maybe let's say maybe probably you trade CLT. So what do you want to see exactly in CLT for you to be able to know it's time to enter the trade, or maybe it's time to exit the trades, all right? So you define your criteria for entering and exiting the trade. So if you have that criteria well defined in terms of your entry, maybe probably, for instance, what it means is that you will have to wait until the entry criteria is well confirmed or it's fully confirmed before you take a trade. So this will prevent you from taking trades prematurely or rushing your entries, right? The same case applies to your exits, right? Because you might rush to exit the trades, and the trades is maybe probably the trend is still not yet over, right? So then the next sheet you can have here, Excel sheet that you can have here is maybe probably position sizing, right? Position sizing and leverage, right? But for the position sizing and leverage, you can also maybe probably write it under the risk management, or you can just have it by itself, because it's also part, position sizing and leveraging is part of risk management. All right. So here we talk about position sizing, all right? Position sizing and leverage. So you define the leverage that you're going to use. Maybe probably your leverage is maybe 1:400. So you have to define the leverage here so that you'll be using a leverage of 1:400. In terms of position sizing, definitely you want to be guided accordingly in terms of your account size. I remember I did a video about how to grow a small account. There I demonstrated how to come up with the lot size. So you can go and check that video and see how we are able to choose the best lot size that we use per trade. But in a nutshell, basically, we are talking like, for instance, you can have something like between 100 maybe to $200, right? You can have something like this between 100 to $200. Here you are going to use a lot size of 0.01, right? Then now you can have maybe probably from $201 to maybe $300. You can use a position size of maybe 0.02. So you go increasing 0.01 with every shift of digit, right? So from 300 to 400, you use 0.03, right? So you can also define maybe the after the lot size, of course, because I mean the stop loss, because the stop loss level is what is going to define, also help you in terms of coming up with the lot size. So the higher the stop loss level, the less the lot size. The tighter the stop loss level, the bigger the lot size. Then you might want to now have a routine review of your trade. So the next Excel sheet here, the spreadsheet here, you can have routine and review, all right? Routine and review. So here you want to outline your daily routine. So maybe probably you highlight what you do on a daily basis. You can say maybe the first thing when you wake up, you look at the economic calendar. The second thing, maybe probably you might also include some things that are not related to trading. Maybe when you wake up, you probably maybe meditate, or maybe you go to the gym and exercise. Then now you come, take your breakfast, look at the charts, right? You look at the charts now, or maybe you begin by looking at the economic events, then you go to the technical analysis, right? You outline your process, your routine, how you do it, right? How you journal your trades. What is the journaling process? Are you going to journal immediately you take a trade, or are you going to journal maybe at the end of the day, looking at the trades that you have taken the entire of that day, right? And what are your review sessions? So are you going to maybe probably review the trades, maybe probably review weekly, right? Weekly, and that is on Saturday. That is during the weekend when the market is closed, either maybe on Saturday or maybe Sunday, right? Then maybe probably, like I said, you are going to detail your journaling process, right? Your journaling process. And also here you are going to specify your daily routine, right? Daily routine. Then the last one you can have here is the psychology, all right? Um, the psychological management, all right? So psychological management. So how do you manage your psychology? Specify how you'll manage emotions and stay disciplined. So maybe how to manage psychology, maybe probably you can say that maybe you're going to only trade when your emotions are okay, all right? So when you have a stable peace of mind, so avoid distractions. All right, avoid distractions when you're maybe probably trading because it can also affect you psychologically. And anything that falls under the psychological management, you can just have it written down here. So what is the purpose of doing this? So also the last bit you can have, because it's part of this, is the journaling, right? So you can have now a journal, trade journal. So, but in this video, I'm not going to talk so much about the trading journal because I recently did a video about the trading journal. So you can just go watch how we create a trading journal and why the trading journal is important. So, but why are we doing all this work, creating a trading plan? Remember, I began by saying there is an old adage that goes by, failure to plan is plan to fail. So in everything that you do, if you want to achieve success, you have to plan about it. So, and also planning will also enhance something we call success, or it will enhance, consistency, right? Planning will help you improve on your consistency. When you talk about consistency, it is very important because um, it will help you now become disciplined. Consistency now is what is going to build discipline. So we say, or it's always said that consistency flows naturally when the purpose is clear. So the trading plan will help you to have a clear purpose. Why are you into trading? What do you want to achieve? So that is under the objective. What is your trading plan or your trading style? What is your risk management? Market analysis. How do you enter and exit trades? Position sizing and leverage. How do you review trades? How do you manage psychology? So that will help you create a purpose. So consistency with a purpose is like following a map. Consistency without a purpose is like following a map without a predetermined destination, right? So if you understand who you are created to be, consistency becomes a natural expression of your identity. So in terms of forex trading, so if you understand what your purpose is and you live into your purpose, that is because you understand what is your purpose is, so you live into that purpose. So what it will do is that it will become a natural expression of your identity. So this trading plan is going to reveal your purpose. So once you know your purpose, what exactly you want in forex trading, therefore now you can live into that purpose. All right. You'll find it now naturally flowing that you are living into your purpose. So it will help you avoid all those common mistakes, maybe psychological mistakes, and any other mistake that traders definitely make in terms of forex trading. So it is very important. So if you don't have a trading plan right away, take a pen and a book, or maybe an Excel spreadsheet like this. Start crafting your trading plan according to the process that I've been able to lay out in this video. And what I promise you is that you start seeing a change in your trading. So if you have found this video being informative, please like, share, and comment. If you have any questions about a trading plan, kindly put them in a comment section and I'll be able to answer all your questions. So thank you so much. Until next time, keep safe and bye bye.